Hello, Accounting 2 students. I would just like to give you a demo of Chapter 26, the Excel spreadsheet. So if you take a look here, I'm going to show you this formula of net present value. So let's take a look, and we have a project here. This page number may be a little bit old, so you can just look at this. Payments made annually at the end of year. Interest is also quoted annually, so you'll remember that when you see an interest rate, it's always quoted annually. So let me see if I can make this a little bit larger for you. Zoom, maybe 150% might work for this. Great. So hopefully you can see this. And we've got a capital investment of $130,000. So, I've been in projects and businesses where they say we want to spend this money and we're just not sure if it's going to be a good investment. We could be investing $130,000 at 12% return on another project, so we want to make at least that. So we're going to look at that as our discounting factor. And we have net annual cash flows of $39,000, and we're going to assume that those cash flows are the same every year for the period of 5 years. Well, if I look at this project and say I make $39,000 a year net annual cash flows, and that's my revenue less my expenses, and I multiply that by the 5 years, I've made $195,000. That seems pretty good. It's $65,000 more than this, but we know as accountants, and we're on the last chapter, which is very exciting, of your book, chapter 26. By now you realize that there's a time value of money, or this TVM concept, and that $39,000 of the first year of payment has 1 year's worth of discounting at 12%. The second years of $39,000 payment will be discounted from year 2 and then year 1 at that amount. So the $39,000 we receive in year 5, in today's value of money, discounted at 12%, is a little bit less than $39,000. So we're trying to find that by calculating what we call present value. So let's go ahead and do the present value. So I'm going to come down here. You can use your calculator if you want to. If you see something in the book about tables, just ignore the tables because you have to look up the right table. And I used to teach table maybe 10, 15 years ago. And even then I still use the financial calculators in Microsoft Excel. So I'm going to just use this column here and demonstrate how it works. So on your Excel, you need to find formulas. So I'm going to look up here, and in mine it says formulas. You'll find another ribbon you might find somewhere else. And I need to find a formula that says financial. And I'm going to look up PV for present value. So I type in PV, and hopefully you have a nice table on yours. My table doesn't always seem to show up. So the first thing I'm going to type in is what's my present value, and I click on it and it tells me my rate. So my rate is 12%, which is my B7, comma, number of periods is 5. I could type in 12% or 5. Then I'm going to put comma, and the payments is minus, but minus in to return the positive is 39,000, and that's all I need to put in. So in this case it equals PV, open parentheses, B7, comma, B6, comma, minus B5, and that will be all the variables I need to find the net present value. So if I invest 130 grand, I get 39 grand back for 5 years. This is the present value of those 39,000 payments coming back to me each year for 5 years. And it's worth 140. Earlier we just said the cash payback was 39 times 5. So my cash was 195,000. So if I actually took that if I took the 130,000 and divided it by 39,000, in 3.33 years, I'd get my cash payback. But as accountants, we know that cash is good, but it loses value, and in this case, it's losing 12% a year. So this 195,000 is good, but we want to value it really at the 140,000 because we're discounting it at 12%. So the present value of the net annual cash flows in this formula here to calculate the net present value, I'm going to put in my 140,586. The decimals don't matter so much when you're talking bigger numbers. Less what we invested, which was 130,000, will give me what we call a net present value. So 140 minus the capital investment. And if this is positive, which it is when you read your textbook, positive means we accept the project. If it's negative, we don't. And in this case, if it's 0 or positive, we accept it. So and for net present value, 0 positive. If it's 0, it means we've made exactly the percentage return that we said we would. If I go in here and say, well, I've made 10,586 above the 12%, as an analyst, I want to know what was the rate of return or the interest rate that would make it break even. So I'm going to put in like maybe 16% here. And get down to 2,300, maybe 16.5. So now I'm getting a negative number, which I was before. So maybe 15.5. You don't have to, maybe 15.4, 15.2. I could do this game all night. So it's around 15.2%. Would be kind of a 15.1, something like that, would be my 0. So I'm making around 15% return on this investment, which, you know, in today's economy, that's pretty good. But depending on the industry and the business, there's a whole bunch of other factors. So I'll change this back to 12%, and that would be my net present value. Anyway, congratulations. This is chapter 26, the last chapter. You've gone through the whole of Accounting 1 and Accounting 2. Just a couple more weeks left and you would have finished the final. And this will be my last Excel I show you before the final review. And it's been a pleasure to have you in class, and good luck.